Oops. There we go. Tom Simmons, coming to you from Bear Services in Shelburne Falls, Massachusetts. This is one of the companies that I currently operate with my partner. And one of the first decisions that we had to make when we launched this company, which is an event planning company, was what form of organization should we use? Sole proprietorship, partnership, corporation, nonprofit, LLC, a lot of choices. And every business that is organizing or that is going through major changes in the goods or services they're delivering is going to have to ask themselves the same question. What is the best way to organize our business? 3/4 of the businesses in the United States are sole proprietorships. It is the easiest, the quickest, and the most common way for small business people to get going. If you've ever gotten some antiques out of the attic or found something in the garage and sold it on eBay as a business, you just launched a sole proprietorship. If you made some jewelry and decided to sell it at a farmer's market or a flea market in town, you just launched a sole proprietorship. You don't need attorneys, you don't need accountants, you don't need to fill out lots of forms and get permissions and licenses. When you say, I am a business, and you launch into business, you have just created a sole proprietorship. Now, to be sure, for certain activities, for certain businesses, there are certain licenses that will be required. If you're a barber, you may need some type of cosmetician's license. But in terms of starting the business itself, simply by declaring you have a business and launching into it, you have created a sole proprietorship. And again, I will say, 3/4 of the businesses in the United States of America are sole proprietorship. Now, one of the reasons is because it's so darn easy to do. You decide, I'm going into business, I'm going to start selling this stuff, I'm going to knit socks and sell them on the internet. It's easy. You just do it. It also means you maintain control over the business and the business decisions. That business is yours and you are the business, and no one can tell you really what to do but you. So you get to rest on your decision-making authority. Now, one of the reasons a sole proprietorship operates this way is because the law treats your business as if it was you. In fact, there is no distinction between you and your business. When it comes to issues like taxes and liability, that becomes a major factor in determining who's paying what taxes and who's liable for what lawsuit. Remember, sole proprietorship, you are your business. That means, number one, the business does not pay its own income taxes. It doesn't exist apart from you. If you own a sole proprietorship, you keep a record of your income and your expenses. You record them on something called a Schedule C on your individual income tax return. We're talking federal income tax return here. And if you made a profit, it goes into your personal income. If you had a loss, it comes off of your personal income. You file one income tax, your company is you, or part of you, and it's over. Now, the drawbacks, of course, to a sole proprietorship are many. First of all, you don't have the advantage of many skills from many people contributing to decision making. And no matter how great you are, very few people are really good at marketing and management and finance and operations and research and development and customer service and creating products and staying on top of all this stuff. Very few people. In fact, I don't think I've ever found anyone who's good at all of those things. And relying on yourself as a sole proprietor to make all those decisions in your business means you're probably going to make some big mistakes because you're not relying on the expertise of others. A second drawback to the sole proprietorship is that if you need cash, and most small businesses will need cash at some point in their life, it's not going to be easy to find. Banks are very, very reluctant to lend to sole proprietorships. You don't have partners or other people involved who are willing to put up some cash and help you out. So you're going to be lacking skills. You're going to be lacking sources of capital, which you will need at some point. But most important is you have what is called unlimited liability. If someone sues your company, if your company incurs a great amount of debt, if there is a judgment against your company, remember what I said defines a sole proprietorship. You are your company. Therefore, a judgment or a lawsuit against your company is a judgment or a lawsuit against you. If someone wins a lawsuit against your company or a judgment against your company for $50,000, you can't just say, well, I only have $2,000 in the company's bank. Oh, well. They will come after you and your bank account and your income and your assets and your house because you are your company. So if you're going to enter into a sole proprietorship, which is what most Americans do when they start a business, make sure you're not starting a company that's very, very risky. Make sure you're not starting a company in a field that has a tendency to gather a lot of lawsuits, especially high denomination lawsuits. Now, the second form of organization that many people go into, and which my partner and I could have considered since there are two of us, is a partnership. And a partnership operates very similar to a sole proprietorship, except now you've got multiple people. So, you have an expansion of skills because, as they say, two heads are better than one. You've got two or more people putting capital or money into the business. If you need outside funding, a bank or an investor might be a little more willing to put money into a partnership. And you do have to draw up some paperwork, but it is still fairly easy to create. Now, like a sole proprietorship, the law views a partnership as if you and your business were one. Therefore, the partnership does not have to file and pay income tax. If the partnership made $50,000 this year as a profit, and there are 5 of you who are partners in the business, then each of you would report, let's say, $10,000 on your personal income tax, because the business is you. When it comes to liability, like a sole proprietorship, a partnership has unlimited liability. And that means if someone wins a lawsuit or a judgment against your firm, your partnership, they can come after the individuals. And every single partner is liable for the full amount of the judgment. So let's say there's 5 of you as partners, and someone sues your business and wins $100,000. That does not mean that they have to get $20,000 from each of the 5 partners. It is perfectly fine for them to get all $100,000 from a single partner. So that is one of the biggest drawbacks to the partnership, is that you end up being liable for all of the debts of that organization. It shouldn't surprise you that partnerships are actually the least common form of organization in the United States for small business. The third form of organization, and it's the one that generates the most sales because it tends to be larger businesses, is the corporation. And we need to spend a little time talking about what it means to be a corporation or not. Under the law, what makes a corporation different is that the law views your corporation as a distinct and separate entity from you. The business is not you. You are not your business. And this has ramifications for many things: for funding, for taxes, for liability. To become a corporation, you and others who are involved, and it will change from state to state, have to file a set of incorporation articles, or articles of incorporation. It's a different name from state to state, with your Secretary of State. So if you have a business in Massachusetts, you would go to the Secretary of State site in Massachusetts and download the forms, fill them out. You'd have to list the initial incorporators, who were the people interested in making this business a corporation, and send it in with a filing fee, and go through a paperwork process for the state to approve you as a corporation. Now, believe it or not, most corporations do not incorporate in the state in which they are located. A corporation can incorporate in any state at all in which they have any business nexus or connection. More than 50% of all the corporations in the United States are incorporated in a single state, and that is Delaware. Delaware is often seen as having the most efficient and the most favorable laws towards corporations, so it's to the advantage of the corporation to incorporate there. Now you may ask, well, does that mean you have to have some business going on in Delaware to do that? Well, the way corporations get around this in Delaware is that the Secretary of State of Delaware is named as an agent of the corporation. And that gives them a nexus or a touchstone with the state of Delaware. And it means that the Secretary of State of Delaware can receive written judgments and documents on behalf of the corporation. It creates the legal basis, and you incorporate in Delaware. It's the single most common place in the country for companies to do that. After you incorporate and you get approved, whether it's Delaware or your home state or some other state, one of the things you'll need to tell your Secretary of State is how many shares of stock you're issuing. Because the owners of a corporation are not you necessarily. The owners of your corporation are the shareholders. Now, that means you can organize your corporation as a privately held corporation or a public corporation. A privately held corporation means you seek to organize as a corporation, but you don't want people on the outside to be able to become shareholders, to be able to become owners. You're not interested in their cash or their involvement. This is very common for small companies. Again, if my partner and I wanted to incorporate our business, this is a viable option for us to be a private corporation. We file the paperwork. We say we're going to issue 100 shares of stock, and my partner gets 50 shares and I get 50 shares. And we are the two shareholders of the company, and that means we are the owners of the company. Very simple. No outside interference. On the other hand, we may want to expand. We may want to franchise. We may want to go global or national. In that case, there's a larger likelihood that we might want to become a public corporation. And what that means is, rather than simply issuing shares of stock to my partner and I, we will offer them for sale to the public, to whoever wants to buy them. So now we may end up overnight with hundreds, thousands, even millions of owners of our corporation. On the plus side, we get a lot of cash in that way. If we sell 1,000,000 shares of stock at $10 a share, we just brought $10 million into our company overnight. And if we're looking to expand and have a new product line and have new offices, that could be very helpful. On the other hand, we just lost control over what we considered to be our business, because the owners of a company are the shareholders, and they will get to exercise their right to vote at an annual shareholders meeting where they will elect the board of directors and decide on issues of executive pay and choose auditors and any other issues that they may choose to bring up. So you've got this tension here that being a corporation makes it more likely that a bank will lend you money, gives you the opportunity to go public and to get investment funds from the public, but you lose some control over your company if you go that public route. Also, if you're a corporation, remember that the government views your company as different from you, and that means your corporation will have to file income tax. This is often called the double taxation problem, because the corporation will have to file its own tax return and pay taxes on the profit that the company made. And then you, as an individual, will also be paying taxes on any money you made from your company, whether it be through salary or through dividends. So you will usually end up paying far more in taxes if you are a corporation than in the other forms of organization. So why would someone want to do that? Well, the big plus side is that you have limited liability. And that means, again, you are not your company. If someone sues your company and wins a large judgment, they can go after the assets of the company, but they cannot go after you. So if you are engaged in a riskier business, if you're selling autos, if you're selling food to the public, where there's a possibility of someone coming down with a foodborne illness, if you're selling something that might harm someone, you might very well want to be a corporation, because all it will take is one person to sue you and win a large judgment. And if you're a corporation, you are personally safe. They cannot come after your house, your bank accounts, your assets to pay that judgment. Only the corporation is responsible for paying that judgment. Corporation also lasts forever, or at least is meant to last forever. If one of your shareholders dies, or decides to call it quits and leave, or decides to sell their share of stock, the corporation goes on, because the corporation is not the owners. That's very different from a partnership. With a partnership, the business is the collection of owners. So that if someone in a partnership says, hey, I've had enough of this business, I'm going to go retire, I'm leaving, you actually have to dissolve the partnership and start a new one with the remaining members. With a corporation, owners come and go freely, they sell their shares of stock, they die and they leave their shares of stock with their estate. There's no problem with the company going on. There is with a partnership, there is with the sole proprietorship. So, those are the three main forms of organizing: the sole proprietorship, the partnership, and the corporation. The advantage of the corporation is that the individuals involved have limited liability. There's a wall that a lawsuit can't come against the individuals. The flip side of that, the payback, if you will, is that the corporation has got to pay its own taxes. Now, there are two other forms of organization that are not that often entered into, but which deserve at least a mention. And those are nonprofit corporations and LLCs. A nonprofit corporation is, as it sounds, a corporation. You go through all the steps you would normally go through in order to become a corporation. However, when you file your articles with the Secretary of State of your state, it becomes very important to tell them up front that you're trying to organize as a nonprofit, and there are very specific clauses they will look for in your paperwork, and this is where it may become necessary to have the help either of an attorney or of someone who's been through this process before. Once you get approval by the state as a corporation, and you only get approval as a corporation, you don't get approval as a nonprofit. Once you get approval as a corporation, you then take your approval and then you apply to the federal government, to the Internal Revenue Service, for declaration as a nonprofit corporation, or a 501c3 designation, named after Section 501c3 of the Internal Revenue Code. In order to do that, you must prove that you are in business for a very, very narrow band of activities. Educational services, health services, you're a fraternal organization, you're a religious organization. It's a very small list of activities that actually count for nonprofit designation. And you must also say in your paperwork that if your corporation dissolves, because nonprofits will dissolve more frequently than for-profit corporations, that none of the assets, none of the money, none of the goods will go to people. They have to go to other nonprofit firms. So you send this in to the federal government and you include a filing fee, and it may take them up to 18 months to make that decision. This is not a quick process. You first draw up your incorporation papers in your state. You send all of that to the Secretary of State with the filing fee. There may be some back and forth in terms of letters or phone calls. They approve you. You take your approval. You then send an application in for nonprofit designation to the federal government. There's back and forth with the federal government, and maybe 18 months later, you get designated as a nonprofit. If you are looking at, running a museum or providing health services to members of the community or other nonprofit type of activities, this is a possibility. And just because you're a nonprofit doesn't mean you can't make a living doing this. You can hire people. You can even hire yourself as executive director to run the organization. It is a way to earn income and to live and to provide health benefits. So a nonprofit is a possibility, but you've got to be engaged in those very specific activities. Lastly is the possibility of operating as an LLC, which stands for Limited Liability Company, not Limited Liability Corporation, which many, many people say. It's a limited liability company. LLCs are very popular in much of the rest of the world, especially Europe and Asia. They are very, very new in the United States. And every state has its own guidelines and own requirements for what it means to be an LLC and what the benefits are. An LLC is generally a smaller business, and it tries to combine the advantages of a partnership with the advantages of a corporation. On the partnership side, it does not file its own income taxes. The profit of the LLC is distributed among the members of the LLC, just as the losses an LLC incurs are distributed among the members of the LLC. So it's not paying its own tax, and from that perspective, the boundary between the company and the members, which is what the owners are called, disappears. However, when it comes to liability, as the name suggests, a limited liability company, the owners or the members do have limited liability. If there is a judgment against the business, the winner of the judgment cannot come against the individual owners. So it tries to balance the best of those two worlds. So you may ask yourself, well, gosh, why wouldn't everyone be an LLC? One of the reasons is, as I said earlier, it's very new in the United States. And the laws describing what it takes to become an LLC and what it means to be an LLC are different from state to state. And they are wildly different from state to state. You may be considered an LLC with limited liability in Pennsylvania, and you may be conducting business next door in New Jersey, and New Jersey may not consider what your company has done to be the equivalent of an LLC. You're only a partnership, therefore you have unlimited liability. The laws are different state to state. Some states, like Virginia, don't recognize the existence of LLCs at all. They don't even say they exist. So, because of the complicated fabric of LLC laws across the country, if you're doing business across state borders, it actually can be cumbersome to be an LLC, and some of those advantages aren't as powerful as they might otherwise be. So LLCs have not caught on in a very big way. They are growing, but there's a lot of uncertainty in the law about them. And for that reason, most businesses in the United States remain sole proprietorships. After that, standard corporations. After that, partnerships, and then nonprofits. So, there's an overview of the ways you can organize. So, let me ask you. I have a business that is involved in event planning. My partner and I tend to set up events, set up bar services or food services. We will do whiskey tastings for community groups or for nonprofits who are doing it as a fundraiser. At these events, we will have individuals taste simple sips of different single malt whiskeys. We have a PowerPoint. We have color charts and taste charts, and we give all sorts of educational information to people at these events, and they're able to try and decide, well, if a particular whiskey smells more like freshly mowed grass or citrus. And we'll do this for 2.5 or 3 hours. That's an event. I ask you, if you were us, what would you organize that as? Would you be a sole proprietorship? Would you be a partnership? Would you be a corporation? There's strengths, pluses, and there's drawbacks and minuses to each one of those forms of organization. I'm not going to tell you what we're organized as, but if you think about what we do, and we don't make a lot of money doing this. It's a very low revenue business. We don't often engage in these activities. They're usually held at private homes or at businesses after hours or at chambers of commerce that have said, hey, after we close down for the day, we're going to have one of these as a fundraiser, and maybe they'll pay us $15 or $20 a head, but they'll charge their members $30 or $35 a head, and the extra goes to the Girl Scouts or a local hospice organization or something like that. And we bring glasses. People bring glasses home as souvenirs. So that's the basic setup of what we do as part of Bear Services. Issues of tax, issues of liability, issues of who's responsible for what, issues of needing or not needing to get funding from banks or other investors, issues of how complicated do we want to make this? Do we want to have to pay annual fees to the state or to the federal government? Do we want to have to be filing annual reports to a government because we're a corporation and the corporation has to do these things? Or do we just want to keep it very simple and folksy? Every business has to make that decision, just as ours did. Now that you've got somewhat of an overview of the ways of organizing, think about that. I think about it as you read the chapter on chapter 4 in our text, and perhaps in some of our online discussions, we'll talk a little bit more about this. All right. Have a great night.